This is Justin Pulitzer. This is my weekend review video for Sunday, August 16th, 2015. A good amount to cover. Let's jump in. As we started last week, we're going to start this week with commodities. That has not mitigated. Oil has continued its slide down. You can see it's getting pretty bummed out in the stochastics. It seems as though the bears are trying for the 2009 crash low. I don't necessarily know if we get down there, and if we do, I don't believe it will be sustainable. It would just be this kind of reset washout. As you can see, we are below these lows. As long as we did close slightly below there, we are vulnerable for still lower. I do think that this is starting to get really overdone, and eventually we are going to see considerably higher in oil, but we may need to see lower and the full capitulation first before we do see higher. You can see we've had declining volume into the decline. Usually for a kind of capitulatory low, you need to see some type of a spike in volume, and we haven't seen that. I wouldn't be surprised to see there be some type of short covering rally ahead of time, but I don't necessarily know if it's going to be the one that will hold. The dollar has softened a little bit, but I will say I kind of emphasized that little bit. You can see we kind of got up to the up channel line and it rolled over. It is encouraging that it broke here and made a bit of a newer low, but that didn't really last all that long. It seems like it's kind of bouncing a smidgen, and we are still closing over the 50 and the 100-day moving average. So the risk here with the dollar is that we get, some type of a spike higher, and that comes up to the 61.8% fib, where the breakdown, from the old highs from way back in the day, there could be some type of a spike move up into this region that would cause a considerable amount of pain, I believe, in the equity markets. I don't believe the Fed is going to be looking to raise, considering what's been going on. I've been in this lower for longer camp. I'm going to discuss that in a moment when we get into the TLT, but maybe we'll do that now, actually. Just get that on the done list. You can see the TLT here, the rates are going lower. We had a bit of a spike up here. It fell back a smidgen here, but we are holding this 123.15. As long as we hold that, I believe that the impetus is for higher in TLT and lower for interest rates. With all the talk of the September hike, we've done nothing but really rally in the TLT, making higher highs off higher lows. This here is the key point. This is the 2009 crash peak, 123.15. Anything above there is bullish for still higher, maybe for the 61.8 fully, although we got kind of close. And then the gap fill up here in the backside of an old uptrend, a tertiary trend line. If this does wind up rolling over, wouldn't shock me to see it get back down into the 120s and maybe even the 119s down here with the 50-day moving averages. So we're going to have to see how that plays out early next week. So the real pain from this commodity routing has been seen in the Dow Jones Industrial Average. And you can see that has really been the weakest. I'll go through the other major indices as well, but this one has been the weakest because this has a lot of the oil concerns like Exxon and Chevron and such. And you can see we filled this gap here. We broke this sort of up regression line, held into where the old highs were, and then rallied. So far this has been weak, but it has kind of not lost its completely lost it, so to speak. We are kind of bouncing a little bit. The bounce is somewhat meek at the moment, although it is significantly higher off the lows. My fear with the Dow, though, is you can see where we came down here into these lows. We didn't quite get the full extension of the lows, but if we start breaking into this area and it starts holding, you can see it kind of held a mini node of a volume distribution. If this snaps, it wouldn't shock me to see it traverse all the way back down into this bar, which was some major congestion. I don't know if this chart is going to show. Let's see how far we go back. You can see that this area was a point of contention for a while. and it was also here where the next volume distribution is. So if we start losing this area here in the Dow, in the diamonds in particular, let's say these 170s, we're probably going to see another 3 to 4 handles lower with the quickness, so to speak. So that's the Dow. Part of the reason why the Dow has been so weak has been weakness in stocks like ExxonMobil, which is obviously the big, the big bad boy of the oils. I've been saying, and we're back here below. We had a bit of a double, kind of like tweezers here, so the risk is potentially a bit lower to the 74.59, which is the big 61.8. I was kind of hoping we were going to tag there quickly for some fills, but it's sure taking its time. It took a while here. We wound up having a false breakdown. It wound up rallying back, and then this could be a similar situation where it winds up rallying back. My opinion with this is that as long as we're below this gap fill here of the 83s, and then also below these lows here in the 86s, that the risk of recession is still on the table. If we can get back above there in Exxon, then I would say that it's probably off the table a little bit more, and we're probably going to see this sort of deflationary trend stop. But until then, the risk, in my opinion, is deflation. I think that the Fed is, talking a good game. I think that they want people to believe that there is a possibility of rate hikes, and I think they want to do that to prevent the markets from kind of bubbling over like that happened in China, and have to kind of avoid having to come in with more policy intervention. But with the strength in the dollar, the weakness in the recent GDP, with the last 3 years having their average mean revisions down, the crappy labor numbers with the high, I would say that the headline number is low, but the labor participation rate is also low. The quality of the jobs, the wage growth, it's all the most stagnant it's been since the quote-unquote recovery has taken place. I'm just not seeing a lot out there that there's a lot of shock risk with regard to China and some of the other, the obviously still the European periphery, although Greece seems to have resolved itself. But I still think that the Fed, in my opinion, if they are truly data dependent, should be on hold. And if they are really true to their nature, they should be talking about more QE, not raising interest rates. But we'll see how that plays out. It's not exactly the most politically palatable scenario for them. Disney has started to trade like a biotech stock. You can see it was weak. It came down. It didn't have the full correction. This has been the problem for every stock lately. They come down. They don't get the full, correction that they should. They rally ahead of time, and then those rallies don't hold. It is above the 200-day. If you're currently long, I would say this 104.24 is your reference low. Since this was a bit of a higher low here, you could also use the 105.51, but I would be looking really for this to come down somewhere into these 96s and 94s to fill the gap. I have an alert here at 95, a little bit arbitrary, but I like to get my orders lined up. If we get a gap fill down to here, I think that this area here, there could be some type of an overshoot down to like these reference lows here of the 88s. We'll have to see where it's not going to just be a straight shot, in my opinion. There's going to be chop and probably fake rallies. Maybe they even fill the gap at some point. But I would be interested somewhere down here between this like 89, 99, 90-ish area. Let's call 90 and 96s. Somewhere in that $6 should be a good area. I'll probably start selling puts as we come into that range. But Disney, to me, the bounce has been feeble. If you start getting some rally back up, maybe there is an attempt to fill the gap. If that happens, I would probably be interested in shorting a gap fill. So it's either going to be long down here or an attempted short up here. If you do want to play for that gap fill, if you can take this swing high here, if you want to get in around 111s, because the one close to 114 is getting, if you clear 111, I think you'd see the 114s pretty quickly. So you could have some good trade locations before you even enter the gap. So over 111, I think you can play long for a bit of a gap fill. I don't know if it's a full fill. I'll discuss it if that starts to play, but I would be, I am looking for lower, and I would be interested buyer, which probably means we get the move higher first. Anyway, SPY. So this is sort of where the rubber is going to meet the road with SPY. We are making lower highs. We had started to make higher lows, but now we made lower lows. We held the range low as I see it with a violation of 2 ticks and then rallied back up, stalled here at the 50 and closed just below it here on Friday. So I was discussing on the Shadow Trader show with Brad that I'm not necessarily saying this is going to happen, but it wouldn't shock me if there is some type of a gap above the downtrend here on Sunday or Monday, and then there's a move back up to the downtrend line. It would not surprise me in the least. The expected move is supposed to be about $2.85, let's say close to $3. So if you take, we closed just below 210. So that's, to me, is a little bit cautious. I've been saying 210 here is the key. We did close below there, so there is potential for a rollover. But I'm going to go over both scenarios. If we gap here and it's a gap and go, I think we see the 11s and we see the 12s and 13s probably pretty quickly, because that would have a lot of people, as the market has people have gotten themselves more and more short in here. I think they would all be wrong and they'd probably cover fairly quickly. Shorts tend to be more disciplined traders. They tend to not play the hope and pray game as longs do. So the longs have been reluctant. They've been paid for a long time. They're sitting on some decent profits. Eventually, when the market rolls over, we'll see how that plays out, how much of that they get to hold. But for now, it's the buy the dip game has been still working. People have still been rewarded for this. Until they're not, that's going to be the case. So I'm looking either for a gap up and go scenario, or we roll back over, retest these lows in here somewhere in the 6s and maybe the 5s. If that fails, we see the 4s, and maybe we, like the Dow, see that fill to this gap here down to the 201.90. I've been playing this with put ratios. On weakness, they haven't really played out because we haven't gotten back down there. It really doesn't matter because those trades are put on for net credits, and that eats up the cost of the trade. So it's sort of a no harm, no foul. Those are best to do when IV is higher. I usually like a 3-point spread with regard to the strikes, so that is how I'm seeing it. Like I said, I would be playing it both ways, either on the gap and go scenario for long, for a squeeze higher, or for a move down lower, which is what I've been saying. If we start violating these hammers, though, I'm going to start thinking that we are starting to form a bit more of a top, and that the risk could be at some point significantly lower. I don't really think we're in panic lights out mode yet. I mean, I think for a healthy summer correction, wouldn't shock me to see these 97s. It would break the channel, though, and that would start turning the picture a little bit. But I had said that a measured move a while ago would take us down to this 61.8, which is the 194s. That's also close to a measured move of a larger correction that we've had in the past. I don't want to waste time and go over it, but it wouldn't shock me to see, if we do snap this, to see that type of a move and then some type of a bounce back. Maybe back, maybe even not even that strong. Like it would be a bounce here, come down to here, then a bounce back up. We'll have to see how this plays out. I'm not as bearish as most people are. For me, this is still just sideways chop working off the excesses from 2013 and 2014. Obviously, the crashes in commodities, the very violent moves in currencies have had me a little bit more cautious. The stock market has stayed stubbornly strong. It's kind of been the honey badger, the S&P in particular, of the lot. So I am seeing some warning signs. I am playing cautiously, but I would not rule out, and I know a lot of people have gotten really, really bearish, maybe just from trader fatigue. I really, believe it or not, wouldn't even still rule out some type of a blow-off type of a scenario. Please always keep all of your options in mind. It's always possible that the move isn't down. When everyone thinks it's down, it could be up. Just saying, I'm not saying that I'm like a mega bull here, but I'm not really a mega bear either. Some other cautionary signs, this IWM. We do have a bit of a secure low in here in the sense that it's bookended by 2 higher lows, although we haven't taken out that this high here. I am still cautious as long as we're below 120.97. I was looking for fills down at 117.37. And of course, we stubbornly stopped ahead of there at 117.97. So I don't know if this is going to be one of these where we didn't really tag back to the full levels that we needed to, and then we're going to roll over again. And if that happens, I don't know if I would be Johnny on the spot, considering we're so close to this, and I think a break of here would get a cascade lower. But I might be interested a little bit lower near these hammers and these reference lows, somewhere in the near the 115s, which is also sort of it's a longer term secondary trend. It's also a large volume spike. I do believe you can play for this move with put ratios. We are sort of in a downtrend within a down channel, lower highs, lower lows. I wouldn't be really jumping long into this until at the very least we get some closes over 120.97 and maybe until we break a down channel. For then, the trend is your friend, and I would be playing for a lower still. Qs have been fairly strong. They've held up. I believe that they strengthened Facebook and Google, and I would say Apple is sort of kind of rolling over a bit. We're going to discuss that in a minute, but it's not really completely falling apart in a completely uncontrolled fashion. Again here, a bit of a secured low, although we are kind of listing back lower. We have been doing everything right. We've been holding the levels we need to see. If this hammer goes, though, I do think we traverse down to here and potentially even still lower into these lows, into the 105s and 104s. And at that point, I would be saying, let's do some right or right out longing, or let's do some short put selling down close to like these, with strikes down in these areas in the 101s and 102s, maybe even the hundreds, because I think that area, that's a really more primary trend. You can see I have the trend drawn differently. I don't want to go back again and waste too much time. Just trust that I know how to draw a trend line. If you're watching this video, you must have some faith in me anyway. So this is these are the right areas that I would be playing for row longs, or if you want to play for put ratios or spreads lower. Why not address the 800-pound elephant in the room, which is Apple? The stock has been rather weak. It had a very large consolidation. It broke the channel. It got back up into the channel more strongly than it probably should have, and then it has completely fallen apart. Back down to here, has now fully filled the gap. As I've been saying for a while, I thought we would see the 109s. So that has all come to fruition. We even had a rally back and failed at the 119s. I had been discussing that I really wanted to see this rally push a little bit further into the volume here, into the 122s, which were the low of the earnings gap, low of day, and maybe even the 125s, which would be the 61.8 fib of the retracement, and then look for that for short. Unfortunately, I didn't drop into this. A few people I know, I shouldn't say a lot, a few people I know did. Congratulations to them. Stock did come lower. I did discuss this being a right or right out trade, and then to kind of prune the hedges in the 115s, and then that's been the trade. We did close a little bit softer on, I wouldn't say we closed soft. This is a fairly okay close. As long as you're over 115.07, which was the flash crash low of day. Let's highlight that let's just do it in yellow for now. But this 115.07, this was the kind of the flash crash day from way back in the day in the charts. I don't really want to revisit that. I've done over that in infinitum in previous videos. I think you can still kind of stay long. Below 115 is, to me, it's iffy, and it's more of a GTFO. You might want to retest these lows. And if things get really squirrely in the market, I do believe Apple has the potential to retest the old high before the kind of 30% correction it had, which would also coincide closely to primary trend. So maybe we do some more consolidation, and then maybe we roll over. At this point, this to me would be a screaming buy for a right or right out long trade. I believe there's a lot of price memory there, and I think that would set up for a trade at the very least. I've talked about some longer-term price targets on Apple. A full 100% retracement of this move would take you to 95s. There's even risk, believe it or not, to 85s if the market really does get violently sick to the downside. If the Fed starts raising rates, if something goes wrong in Asia, there's a lot of potential and a lot of people who are sitting on profits, and there are a lot of people now wrong in Apple. So just keep that in mind. I do believe that this worst case, quote-unquote, scenario will hold off for quite some time. into past September at the very least. There is going to be the new iPhone release. I believe that's September 7th, so that will be a catalyst to probably be long into the event, and then we'll play, sell the news and short that day, as we always do with Apple, which always seems to work. If it's had a big run. If it has not had a big run and people are all trying to game the same thing, it could be a reverse situation. Price matters. Everyone always asks me, what will you do for this and that? And I always say, let's see where the stock is. It really is relevant. Price is what is key, and price is what is truth. Google has been what's kind of been keeping the NASDAQ from kind of completely tossing its salad, so to speak, here. As long as it's above 678, the play is long. Below there, to me, gets a little bit more iffy. We were up on this spike news here on the fact that they're reorganizing the company. I guess they're splitting out the Moonbase from their search business, finally. Maybe they'll unlock some value. I think they want to get some more credit for their web-based services like YouTube and the such. But stock is fairly bullish. The stochastics are kind of softening a bit, but like I said, 678, that's the key. Above is bullish, below is more bearish. Facebook hasn't gotten quite the pullback that I would have liked. The stochastics are starting to roll over a little bit. Did have some nice relative. It has had a lot of relative strength with regard to social media. We all know the horror show that has taken place there, and names like LinkedIn, Yelp, and in Twitter. I'm actually starting to warm a little bit more to Yelp. I'll discuss that in the I think in the video for Periscope this week. We'll discuss that, but I don't want to get too ahead of myself there. But with regard to Facebook, we are pulling back. I've been looking for some type of a play off the 50-day moving average. That's been a key level before. We haven't quite gotten there. And potentially the fibs down between 83 and 85. I think that area would be a solid buy zone. Their numbers were fantastic. I believe there's a lot of people who are kind of playing this. I think that this deserved the strength it got. I think it didn't get the kind of reaction it should have gotten on earnings because it had run so much on the Google numbers. So I think it's just burning off a little bit of that excess. In stark contrast, the disaster that has been Twitter, anything below 29.51 to me is still vulnerable to still lower prices. We did touch down into sort of close to these 26s, which were the pre-IPO prices. I do believe there is going to be some type of a bounce in Twitter. I don't know that. I think there's a lot of people kind of hoping and praying in this stock, and they're hoping for a takeout. It's very hard to speculate on takeouts when fundamentals are deteriorating and it's a no-growth business. Companies want to buy growth. The earnings numbers have been fairly decent with regard to Twitter, but their growth numbers are lacking. They need to do something to boost that up. I know they have the new deal with the NFL. That's a really good start. Now I just need to see MLB, NBA, FIFA, NHL, and so on. That would be great. I do believe that they have a unique property in the sense that they are the new CNN. As these companies have their ratings deteriorating, all of the information, like in the debates, everyone was talking on Twitter. That Facebook, again, just stole the show there. They were the co-sponsors with Fox, but there was a lot of talk on Twitter. They just have to figure out how to grow their user base. I keep hearing from people they don't know how to use the damn service. They have to make it more simple, and I think more Instagram-like. They're either going to have to make it dumbed down so that older people know how to use it, or they're going to have to make it more advanced and more young so that it kind of has an appeal to the youth. It's sort of just in this middling generation here, and I think that's really been what's the problem, to be quite frank. The VIX has been not showing signs that I think the bears would like to see. Moves over the 200-day have not been sustainable. It did come down here and made a newer low, which could be an anchor low for the VIX. I don't know if we're going to start reversing and making ourselves into a newer, higher volatility environment, but we do have about an equal top here. It is coming back down, so this is sort of good news for the bulls. So let's just see, VIX tends to trade in a range. It's usually at the low end of range is in like the 11s, 12s, and the high end of range has been in the 20s. Till I really start seeing that pattern change, the buy the dip thesis is still going to work. I'm sorry to tell that to the shorts, but that just is how it is. FXI, China we know has been a debacle with regard to their markets. They're also slowing significantly. There's a lot of currency issues. They've started to devalue their currency, which is, I think the reason for, like I said, for the weakness in the Dow, it's been hurting a lot of these companies that have international business. They are not going to be making as much money on their sales because they're having currency headwinds. China, on the other hand, is manipulating their currency lower. They've devalued it 3 days in a row, the largest in 20 years. That should start bolstering some of their businesses. My real issue, though, with China is that a lot of the companies are state-owned entities or partially owned entities, and they're sort of like zombies with regard to their balance sheets, but they, of course, have the government propping them up. This looks like it's trying to make some consolidation. I would say that I don't know that I'm saying it's going to it's trying for a higher low here, but it hasn't retested these lows, which I guess is a bit encouraging. We're kind of hovering around that 61.8. Believe it or not, as bloody as China has been, the market is still up on the year, which is insane. I do believe that there is going to be a rally on a separate leg to a lower high before the poo hits the fan really hard. So it wouldn't shock me if this does get taken, or if it holds and then there's some type of a move back up into the middle of the range or something, and then a harder rollover. But China is showing some signs that it might be trying to just stabilize here, and that just stabilizing would be good enough for the U.S. You just don't want to keep seeing these crash, overnight down 600 point type of moves. BABA, again, discipline saved me here. I said that as long as this was above 80, it was okay to be long. Below, it was a crapshoot. And look what happened here. We printed fresh lows. The pre-IPO level was 68. I would be looking to play for that with put ratios on weakness. We did rally. I think there were a lot of people who were short. They rallied, and what was support became resistance. We are still below there. As long as you're below 76.21, the risk is still lower. If we could get back above there, maybe there's a move to the downtrend line back up to 80 or something. If you are curious what I'm talking about with regard to the risk discipline, check out my Risk Management 101 strategies. That will keep you out of debacles like BABA, or at the very least keep the losses minimized. Amazon just chugging along, staying strong. Long and strong, right? This had a bit of a look below, fail and reversal. It probably wants to chop a little bit more into the bar here. I do believe this is going to be strong for the fourth quarter. Selfishly, I would like to see this thing pull back so that there's an opportunity to buy it. Maybe it gets a gap fill. Maybe there's some type of a larger market pullback, and we get a move to the lower part of the channel. We are trading above the channel, though. So keep in mind the very first test of the backside probably will hold and be buyable for a bounce. That's what I've been looking for with Amazon, or some type of a move back up over these highs. You really need to see it over this high, which is the earnings gap, the failed bounce high of day. So anything above 544.95 is bullish. Let's set an alert. 544.90, let's just do it at 95 so that it doesn't take off. At or above, we never use mark, we always use what really is trading. Anything above there I think is bullish for a move higher, but I would be looking for a bounce here off of the backside of the trend. FireEye has been a bullish stock, but it has been pulling back quite a bit lately. You can see the pattern is very similar to here. Wouldn't shock me to see a little bit lower. You can see the backside of the old downtrend channel. Just like I was talking about with Amazon, you can see we broke the channel, but the downside or the backside of the old down channel has been supporting. I'm not sure if this is going to rally up and we're going to get the test of the backside, which would also maybe coincide with the 50-day moving average, which to me would be a great right or right out short, believe it or not. But I would like to see some type of a flush down to like the 200-day, or maybe down into these reference lows, 36s, 37s, wherever, some type of a move down, and I would be a buyer in that area. I think that we can kind of set up for a nice bounce play. With that said, the pattern is lower lows, lower highs. You really need to see that pattern reverse before you start getting bullish, particularly with the channel break. Those can get sloppy quick, but I am bigger picture, longer term, bullish on these stocks. I believe that cybersecurity is a huge problem and is going to be with us for many years to come. You can see Palo Alto was one I was bullish on. Someone had asked me what it was the 50-day the buy here. I had said I didn't think so just because of the big engulfing nature of this candle. It did bounce up the 50. What was resistance becomes what was support becomes resistance, and now the stock is weakening up. I'm now looking for the primary. This is really a secondary trend. Primary trend, believe it or not, is all the way this far down. I mean, you're talking about close to 100. But I would be looking for some type of a move, into this area. I think would set up for a good right or right out bounce. It'll probably coincide with a 200-day moving average, and that could set up. Let's see how it goes. Earnings are coming up. I'll probably be trading it after earnings. If it gets really bad ahead of time, then I'd probably be playing it ahead of earnings. But let's see. Again, price matters. JetBlue. Everyone keeps, I wouldn't say everyone keeps asking me about airlines, but anytime anyone asks me about an airline, I just say that just to look at JetBlue, don't outthink it. The chart is the only one that still looks bullish. The other ones got obliterated. This is now kind of challenging the highs. It keeps backing off to higher lows. It probably is going to have some type of a blow-off type of a move at some point. The 1.618 is we're getting kind of close to there. So if we do get up close to 25s, that's probably a good spot to trim and trail a little bit. But I do think that there is some room still higher. If this does wind up coming back down, if there's some type of poor highs here and this backs off, I would be looking to still buy the dips. Netflix. Holding strong. I've been trying to play this with put ratios for moves lower. It's just staying stubbornly strong. Everyone seems to be kind of now realizing that the Netflix model was the right model. Disney is having trouble. All of the, everyone keeps talking about wanting to buy these cable companies like the Time Warners and the telcos, like the Verizons and the AT&Ts, all because they have dividends. These companies now have lost their pricing power. They have cord cutters. They have disruptive technologies that are coming into their fields that are going to hurt their prospects of future dividend increases and future earnings. They're going to be all cutting and lowering prices. Those are not kind of companies you want to be in. You want to be in the ones like the Netflix, the ones that are taking the share. However, Netflix has run a lot. This thing is like a phenom. It's like the Incredible Hulk. It just keeps chugging and chugging. At some point, there's going to be something that happens in Netflix where people don't like it. Wait to buy the dip. If you're long, I would say you have you're okay as long as you're over the earnings gap high of day, the 116s. We are significantly higher than that, though, so maybe you want to use like this swing low, the 118.66 or so, or really the 20-day moving average. When these stocks are in bull mode like that, the 20 is really key. I would use the 20 as my stop if I were long. If you're short, you can be against the 129.29, these kind of double tops here. To me, this is just sort of a wait and see at this point. I think it's run a lot. It hasn't pulled back much. Probably will wind up still going higher, though, believe it or not. Price line did what I thought it was going to do. I discussed pulling back, filling the gap. It's either now going to be go time back to the upside or could retrace still lower into these moving averages down to the 50% and maybe even the 61.8 fib, which is the channel low. That would be a phenomenal right or right out trade. I really don't just see it falling apart like this. It doesn't seem likely. You can see, look here, we gapped here, came back down, filled the gap, and then she ran again. So that is kind of what I'm looking for here. With maybe a slight move a little bit lower, but price line to me still looks fairly bullish. I think it had just kind of run a bit on Expedia, and then it kind of did pull the Google. It had run a lot ahead of time, and then it was just people taking profits back at some reference highs, which I had discussed on the stream. So that is price line. Shake Shack. Finally, we got the options. I've been lobbying and trying to get these options done for a while. They finally did a secondary. They had really crappy price action, though. This thing gapped up big, and it just fell apart afterward after the earnings. Their earnings were pretty good. The problem for me with Shake Shack is that it was a story of a heavily shorted stock without a lot of supply, and this was just really a short squeeze. You had a protracted pullback, you rallied back up, and now it's kind of coming back down. I would not shock me to see some types of attempted rallies in here, but I do think that we are going to revisit close to or revisit those lows somewhere down near the 38s. If you want to try some right or right out action somewhere between these 48s and 52s, you can now sell some out of the money puts if you want, or buy some call spreads. I'm more into probably selling some puts or put spreads, and then that could be your long proxy and you get stock a little bit cheaper. I will be a buyer if we do get the channel low and a move deck down to 38. If it does wind up rallying again, then sometimes you just have to say you missed it. You can't catch every move in every stock all the time. TASR held primary trend. We are kind of just chopping down here. This is really key area, the 23s. If we lose the 23s, we're going to see the 21s and 20s quickly. That to me would be a good right area. The old hop in TASR was 2083. There'll be a lot of price memory, in my opinion, down here in the lower 20s. Although it will start being maybe a kind of a sell the rip stock then if that happens, in my opinion. It'll take a long time to recover. It would not shock me to re-see the $30 area, though. That was really where this sort of head and shoulders took place. Usually head and shoulders break down, retest, and then can either go up or break down again. So I do think that this will at some point come back up and see the 30 buck. I've been kind of nibbling a little bit long down here for a trade. And let's end it on Tesla. Tesla did a secondary. They actually wound up doing even a little bit more shares than they were supposed to. Elon Musk bought about $20 million worth. The print on that was 242. Let's keep it simple, stupid. Anything over 242, bullish. Below, not so much. If it is below, I do think we can see the 21s, the 25s to 21s, and potentially the 205s if the market really gives it up and oil keeps crashing. It's going to be kind of hard to have that. That being hard to be, keep up with solar stocks. And if you want to see what I discussed about solar stocks, take a look at my Periscope from this past week. I go over Sun Edison in quite some detail. That's also a case in point risk management lesson. Anyway, I wouldn't be surprised to see this gap fill. I've been talking about some Fibonacci extensions in past videos. I do think at some point we see that. They kind of have the wind at their back. That Powerwall is doing really well. They have the Model X coming out and just some various other stuff. Tesla's just cool. I mean, Elon Musk, they used him. He was the basis for Iron Man, for Christ's sake. Anyway, I do think that the 242 above is bullish, below is bearish, not so great. If you're not following me on Twitter, be sure to follow me on Twitter. My handle is @JustinPulitzer. If you like this video, please hit the like button and leave some comments. You guys and girls help me make the videos the best they can be. The feedback is always welcome. Please hit the subscribe button. You'll be getting notifications for new weekend review videos as well as Periscope rebroadcasts and special edition videos. I have some really great ones that I have planned up that should be coming up soon, so be sure to just hit that subscribe button lower. Anyhow, let's have a great week. That's my story. I'm sticking to it, and cheers.